I'll share my screen. I mentioned to Chris earlier on. It's actually my mum's birthday today, so we've got a family Zoom call at about 7:30. So I'm gonna be a little quicker than I usually am. Many of you will probably be very happy to hear that.
Don't you believe it?
But thanks, Chris, as always. Great to be here. Always love coming on and presenting to everyone and giving people updates on what's going on in the mortgage and lending markets. So, um, as always, what I do isn't just limited to this presentation. You can find me across pretty much every social media platform, and I also am actually the host of a podcast, the Game of Loans podcast, that you may well have come across before as well. We're up to episode 81 was released today, so I've been doing that for over a year now, getting a lot of the great and the good of the property industry on that. But you can contact me in a array of different ways, which you'll find on the screen at the moment. Um, in terms of today, we're gonna keep it a little bit briefer, as I said, and I'm just going to go through the a mortgage and bridging and development market update before moving on to a quick Q&A at the end. So if anyone's got any questions about anything to do with lending at the moment, then they can ask their questions then. I'm pretty certain Chris is going to jump in early doors with something hard for me. He likes to test me out on these calls. Um, but to kick things off, let's talk all things mortgages. Oh, press too many buttons there. So, firstly, it's starting to be a similar sort of thing, month on month. Pretty much all year now, we've really not seen very much in terms of rate changes. The market is very, very settled. In fact, it's probably as settled as I've seen it in my 14 years of working in this industry. Not seeing too many changes at all. Now, of course, one thing that we are predicting is a little bit of change next month as more and more lenders come into the 95% loan to value region for residential mortgages. So I can certainly see maybe a little bit more competition at 90 and 85 on the residential side, but certainly on the buy to let, HMO, service accommodation side, very little changes, which I think can only be seen as a good thing. Nice to see a bit of stability. Um, the as much as it's good that there hasn't been too many changes, one thing that we are seeing and don't think it's going to be changing too much in the near future is that the more specialist part of the market, sort of HMOs, serviced accommodation, these mortgages are still quite expensive when you compare them to where they were sort of pre-COVID. We're doing a mortgage for somebody on a serviced accommodation apartment at the moment, and the rate's 4.5%, which if we were doing exactly the same deal just over a year ago, we probably would be looking about 1% cheaper, maybe just slightly under. But it goes to show that that part of the market's still got a little bit of a way to go to return to normal. We are doing an HMO mortgage at the moment, just shy of 4%. But yeah, typically speaking, especially on the SA side, we're still looking at rates in the sort of 4 to 5% region, which for me is a little bit too high. I'd prefer them to be a little bit lower than that. But having conversations with lenders, they're all sort of suggesting that that's not going to change much throughout the course of this year. So if you are waiting for rates to come down on your HMOs or SAs, not looking likely in the near future. So hopefully that won't be anything that sort of puts you off delving into that market. Another thing that we're seeing a lot more is on large HMOs. Now, many of you are going to be pretty well versed in how this works, but for those of you not in the know, generally speaking, if you're looking at a C4 classified HMO, we don't really get commercial valuations on the whole, but historically we have had commercial valuations on sui generis or a 6-bedroom and above HMO properties. But we're finding more and more lenders are actually shying away from these at the moment. They're going for more traditional bricks and mortar values on these. I have got a call lined up on Tuesday next week with one of the bigger commercial lenders to sort of delve into this in a little bit more detail. So hopefully on next month's call, I might be able to do a little bit more on this, because I think it's quite important. But generally speaking, we're seeing commercial lenders not always guaranteeing commercial valuations on residential properties like they were previously. And that goes for some sort of multi-unit blocks as well. lenders and solicitors are incredibly busy at the moment. I've spoken to a few solicitors. A really good friend of mine is a cracking commercial solicitor, and we do a lot of work together. And one thing he said to me the other day, actually, because we're working on a bridge for an auction property, and he said that he's not struggling, but he just said, look, normally we would get this across the line very easily, but this time round it might not be so easy. And he said it's definitely sort of the overhang from the fact that there was a lot of transitions lined up, thinking that the end of March was going to be the end of the stamp duty holiday. And so even though that stamp duty holiday has now been extended in there's sort of two tranches, we are still seeing that quite a lot of people had prepared and were pushing through on purchases with a view to be completed by the end of March. So at the moment, this is sort of overspilling certainly into April. Lenders and solicitors very, very busy. We're seeing on the mortgage side, generally speaking, queue times for between application and actually an underwriter seeing a case around 5 working days, which is a little bit higher than the normal sort of 2 to 3. So just bear that in mind. If you do have a deadline, you might want to have a conversation with firstly your solicitor about their capacity, and secondly, in terms of choosing a lender, you might just want to ask them what their normal turnaround times are at the moment, because they might be a little bit longer than you would be expecting normally. Now, last thing on this is all about bounce back loans. Now, some of you may remember in a presentation I did, I think towards the probably mid last year, talking very much about how bounce back loans from mortgage lenders were a complete no-no. Now, across the board for residential, on the residential side, pretty much the same thing, but we are hearing from a couple of commercial lenders now on the residential property side that they are looking into how bounce back loans could potentially be used, because if you run a property business and you've taken a bounce back loan through your property business, then surely using that bounce back loan to further your property business falls outside of the guidance that the government set about buying assets with those loans. So again, stay tuned for that. When I have the conversation, I've got a couple of conversations lined up next week with some commercial lenders to talk about this, as well as the commercial valuations and things like that. Hopefully I'll be able to report a little bit more on that. And certainly I will be reporting on that across my social media channels over the next couple of weeks. So moving into bridging and development then, certainly one thing that we're seeing is a lot of competition for rates. A lot of competition for loans, particularly above 100,000. Lots of lenders coming back into the market, and we are seeing a reduction in rates. I was quite shocked the other day. Quite a tricky bridge that I needed to organise for a client at 70% loan to value came back at under 0.7% a month. I was quoting about 0.8% to the client. So I was quite surprised with that. This was actually with a lender that I really enjoy working with, because they do their underwriting at the beginning particularly quickly. They offer an offer in principle usually within 24 to 48 hours of submitting the application, which is fantastic. So on the whole, we are seeing that rates are starting to slide a little bit as competition comes back into the market, which is really positive. More lenders as well raising their sort of loan to value thresholds when we're looking at basing the loan amount on the open market value. Now, for those of you that have been listening to these presentations for a few months now, you would have seen me presenting about various different options of getting bridging based on the open market value rather than the purchase price. If the purchase price is a reasonable amount lower than that open market value. And we're seeing more lenders now actually being able to borrow up to 100%. We're doing one at the moment where the client is actually being able to borrow 100% net. So the gross loan that they're borrowing is actually more than 100% of their purchase price. The net amount is exactly spot on what they're purchasing this particular property for. So if you are looking to purchase a property that is, that we can prove that the open market value is higher, if you're strapped for cash, or you've got a couple of projects on the go, there's going to be opportunity here to look at some flexible lending on that side. And this is a part of the market I see growing over the next few months. And again, if you have equity in your own home, lots more lenders starting to be a lot more flexible in terms of using that equity. There is a little bit of a loophole insofar as this kind of regulated, FCA regulated loan versus FCA non-regulated loan. The unregulated stuff is generally our bridging development, buy-to-let loans, this sort of stuff. And if your borrowing is secured against your home, it comes under the FCA regulation. A lot of bridging lenders don't have the FCA regulated license in order to do those loans. But there is a little bit of a loophole where that if you are borrowing on a second charge basis, and that money is to be, or those funds is for business purposes, then it can fall outside of the FCA's regulation. As a result of that, we're seeing more and more lenders who are able to look at this to utilize that equity in your own home by suggesting, well, hang on a second, if that money is going to be sent to as a director's loan into your limited company, that surely is for business purposes, and therefore it falls into this sort of little loophole. Whether this gets closed up or at some point in the future, who knows? But I've been doing this for quite a few years, if I'm honest with you. As I put on the screen, this does come with caution. I would always explore every other avenue before over leveraging your own home. But if it is something that's going to allow you to really grow your portfolio, it's something potentially to look into. And I'm seeing more lenders coming round to this idea now, which is great. One thing that I've seen in the last month or so is that monitoring surveyors, and these are the people that go round to meet with your builder if you're getting development finance to look at your schedule of works and work out the sort of the schedule of payments on your development finance tranches. They're starting to be a little bit more over cautious. We've had a problem with a development finance loan in the last month, where the difference between what the MS thought that the build costs should be and what the genuine build costs actually were was quite a big distinction. There's about a 15% difference. Now, because of the PI cover and the criteria surrounding the funding lines, the lenders have to go by the MS figures. Also, the reason that they go by this is that if something should happen and the developer is hit by a bus, and the lender has to jump into the project and actually take over the running of that project, they have to look at what the costs are going to be like to them, not somebody that maybe will be able to do some of the work themselves, or might be able to cut costs because they've got a good relationship with the supplier or something like that. Now, what will happen in this instance, and this is what's happened on this particular loan, is that they will ask you to pay the difference first. So they're still potentially going to lend you 100% of your build costs, but what they will do is the difference between those two, they will basically shift to the front end, and before you'll be able to draw down on any of your development finance, they will expect you to put funds into that amount. So just something to be wary about, because this can obviously cause cash flow problems. Just starting to see a few more of these things crop up. So again, buying at auction. I've obviously already mentioned that solicitors are quite busy. Lenders are also very, very busy. I've had a client this week reach out to me, called me and said, "Sam, I've got some great news." I said, "Okay, brilliant. What is that?" I've just won a property at auction. Fantastic. Thanks for telling me after you've won that auction. We've got a lot of work to do. I mean, luckily, in a 24-hour period, we got terms together. We submitted a full application. He didn't have a solicitor, so I got my preferred solicitor on board with that as well. So within 24 hours, we were on track. But this is a bit of a word of warning, if you like. Be prepared. If you're going to go to auction at the moment, have all of your ducks in a row. Let's get some terms and figures prepared from a lender. Let's get them credit backed as well, and let's do it at our worst possible case scenario. So even if you think you might be able to buy that property for 370, let's do it at 400 potentially, if that's the maximum that you would go to, just so that when we go back to the lender for the application, if you buy less than what you're anticipating or what we got the figures lined up to, we can sort of scale that back a little bit. I wouldn't advise at the moment going for development finance on an auction purchase, because as I mentioned above, we are not just having to get a survey on those, but we're going to have to get a monitoring survey visit on top of that. And at the moment, I mean, the last one we did, the monitoring survey took 10 working days to get the report finalized and sent back to the lender. You're buying at auction, you've only got 20 working days on average to complete if you take away weekends. So generally speaking, you're probably not going to have enough time to get it across the line. So be prepared, have your funding line up if you're buying at auction, particularly at the moment. as lenders and solicitors are particularly busy. So just a bit of advice from me. But as I said, a slightly shorter session today, but happy to take a few questions as long as I'm not too far. I've probably got 5 minutes, so maybe 1 or 2 quick fire questions.
I jump in.
Absolutely.
The question has actually been answered, but I'm going to ask it for the purpose of the recording. So I just wanted to know what MS stood for, because it's all the terminology. We don't necessarily all understand it.
Yeah, it's monitoring surveyor. So a lot of people think, why we're getting development finance, why are we getting 2 surveyors? Got 2 surveys being done, the extra cost and all that sort of stuff, and time. So the surveyor is exactly the same as a surveyor that would go out on a bridging loan or many other different loans. They're going out to look at the current purchase price, and they're looking at what the GDV, the gross development value, is going to be. They're also probably going to do 180 and a 90-day valuation on that as well, which is if the sales time was limited to 3 or 6 months, would that make a difference to the value? But then after that, the monitoring surveyor is a different surveyor. They are going out to meet the build team to work out A, if the cost of funds is correct, and B, how long is it going to take to do the work, and at which point should the stage payments be made. Now, I've had a lot of back and forth this week on a particular development finance deal because the MS and the client can't agree on when these stage payments should be made. There's a lot of back and forth in terms of making sure the cash flow works. I've had to even be on the phone to the head of credit at this particular lender trying to figure out how we can do it. So the MS plays a really, really important part in this process. But I hear a lot of people say, "Oh, development finance takes just as long as a bridge." It doesn't. You probably need to add a couple of weeks on, definitely, when it comes to development finance, because you do get this element of after the underwriting and original survey is done. So that's a long-winded way of me saying MS means monitoring surveyor.
Thank you.
No
It's
problem.
all about learning.
That's good.
I'm waiting for a hard question from you, Chris.
So I have got a question. Okay. Sorry about this. We've got a bit of feedback here. Can you hear me okay, Sam?
I can hear you perfectly, yeah.
Yeah, brilliant. So I've got a couple of things. One is the ability to raise funds from the equity in your own home. But basically, you're sort of talking about a second charge, really.
Mm-hmm. Yeah.
Assuming there's no lending on it at the moment. What sort of interest rates? I know you said you don't go into it lightly, and I think that is really good cautionary tale. But I just sort of wonder what sort of the typical interest rates would be on that.
So what a lender will do is they'll look at it on what we call a blended rate. So it will be one loan, but you have to think a certain percentage of that loan is going to be on a first charge, a certain percentage is going to be on a second charge. The last one that we've just done, which actually we applied for today. In fact, I applied for it about half an hour ago. Literally, I pressed the email and then clicked on the Zoom link. Was it as at 0.65% a month? Which actually was really good. When you look at so what the lender will be looking at is the overall loan to value between the two. Obviously, the lower you can get it, the better. This is actually, I don't push towards this often. I think it's something that people should be wary of as an option for them, but I don't push it too much. But if you are quite heavily geared at the moment, 75%, 70% is really the market norm. There are a few lenders that will go to 75%, but utilizing a little bit of equity in your home actually is a really good way of bringing down that overall loan to value. So you might actually find that the rate is slightly lower by doing that. And if you get below 60% across the available equity of the first and the second, there are lenders that don't even need to send a surveyor out for those as well, because they'll deem the risk to be quite low. So we can negotiate on that. Not all lenders will do it for all brokers, I've been told, but a few have promised that they'll do it for us. And we have done it once so far this year, where it was I think it was something silly like 59.8%. But they still said, yeah, that's no problem. So there was 3 properties, which normally would have cost us, £1,500 potentially per property. no valuations. Did it all based on index, which was great.
No, that's good feedback actually. So thanks for that, Sam. The other thing, right at the start, you spoke about the HMO and SA mortgages. Were the rates there were compared to others still relatively high. What would you say is the reason for that? Is it just risk or something else?
Yeah, I think for whatever reason, I mean, I've always said I think there's a ton of stuff that's brilliant about our lending market. I think it's one of the best in the world, if I'm completely honest. But one thing that always frustrates me is that lenders are sometimes can be a little overcautious, and they can also be a little bit behind in terms of actually what's going on. And I think this is a really good reflection of that. The fact is that HMO, from my understanding through speaking to a lot of my clients who are HMO landlords and to some big players in the market as well, it really hasn't been affected that much. If anything, HMO has become a really, really important part to a lot of people's lives. In fact, one of my employees lives in an HMO, and she said it's been fantastic because she's actually had the ability to socialize with people where others haven't.
Yeah.
And an SA, I think, and you'll probably know this more than most, Chris, we are looking like we're going to be heading for a little bit of a staycation boom over the next year or so. So realistically, I don't really understand why lenders aren't starting to take advantage of this, because there are lots of people. The number of inquiries for HMO and SA that I'm getting or I have had this year is probably as high as it's been in the last 5 years. So lots of interest, but again, lenders not reacting to it as I would have liked, unfortunately, because they're seeing, I think, a lot of the negativity surrounding those two types of assets in the news or the media, not really seeing it in terms of how it actually is in real life. That's the problem.
No. Okay, so, I mean, obviously, so I've heard lots of stories of people moving from service accommodation and purchasing properties onto ASTs because it was easy and it was a sort of risk mitigation strategy. So it's interesting that you're seeing, a healthy demand for service accommodation mortgages. That's really good. My last question is: I was quite impressed with this 100% lending. I wasn't, I can't let you get away with that. I think it might.
Amazingly, you do, yeah.
I thought you might just sort of expand a little bit on how that was even possible.
Yeah, so this was quite an interesting case actually. This exact case I've been working on recently, where the net loan actually was, in fact, it was probably about £100 above the what the client is actually going to be passing over, what they're actually going to be paying for this property. They are buying a property from a family member who essentially has a portfolio, and they're offloading steadily their portfolio as they've reached an age where they're done with it, really. And so they've been able to not only buy below the market value, but because they have to be very cautious. If you're buying a property and the market value is here and you're buying it way down there, especially if it's there's a relationship there, we have to be really, really wary that the HMRC might see it as stamp duty avoidance.
Yeah.
So what they're actually doing is they are buying it below market value, but the difference between what they're purchasing it for and what they're actually going to be passing over in monetary value is gifted equity.
Right.
So there is quite a big difference in this one, and so the lender has been quite comfortable in lending 100%, well over 100% of the official money that's going to be exchanging hands on this one. But having said that, so far this year, this is going to be the 5th bridging loan that we've done, where it's going to be based on the open market value rather than the purchase price. This one's the highest that we've done as a comparison of the purchase price, but the others, 2 were at 90 and 2 were at 85% loan to value. And so there's ways of doing this, and actually you can use that same model for an exchange with delayed completion as well. So if you're buying the property, renovating it between exchange and completion, we can get everything lined up, including the legals, and all we do is delay the valuation until the work's been complete. Valuer goes out, values it as it is, then lender will base their loan on that, because actually at completion the property is value, it's going to be worth a lot more than you're paying for it. So if you're doing a quick flip, that's a great way of A, being able to borrow more and put down less, and B, actually borrowing for a less amount of time, because instead of borrowing it for the time that you're actually doing the works and then for the marketing period, you're just borrowing for the marketing period. So overall, even though you're borrowing a bit more, your loan to value might be a bit lower. So that will help. And also your cost of funds over the real pound for pound cost of funds is probably less than what you'd pay normally. So we've, in the last 6 months, I've done about 3 of those. Brilliant. Really, really, really good way of maximizing your opportunity for something like that.
Wow. So that does sound good. So do you think you could then get a loan for the actual, so the on-market value, or 75, so as an example, could you get a loan 75% of the on-market value, which actually covers the purchase price, and so then from day one you've got none of your own money in?
Typically they'll limit it to 70% of the open market value, but yeah, if the figures stack up, if we go and get a valuation that says the property is worth 100 grand, just to keep it simple, and you're buying it for 70, no problem.
Right. Oh, interesting. I've got more questions, but it's your mum's birthday, and
I know.
But you've got to look after her.
I can feel my wife's eyes like piercing into my forehead from across the room.
well, please send us all your mother our best wishes for your mum's birthday anyway. Thank
you very much, guys, and yeah, I'll see you all next month.
I'll just quickly check no one's got a burning question for you, because I've sort of monopolised the questions. So sorry about that, Sam. So I'll just quickly ask if anyone's got a quick question for Sam.
I was going to ask, very good. You mentioned about, but we can go on and do it another time. You mentioned about people potentially swapping from their SAs into ASTs. If they have an SA mortgage, how does, or the reverse, a buy-to-let mortgage, maybe we can answer that next time, but I'm just wondering how you deal with that scenario.
Yeah, very, very briefly. So if you're going from SA to AST, most lenders won't have a problem with that. If you're going the other way round, then they would, because they wouldn't be. Some lenders aren't going to be comfortable. Pretty much every single lender that will lend on a short-term basis, in terms of like an SA type mortgage, they will have products for standard buy-to-let. So effectively, it's lower risk because you're putting it onto buy-to-let, but you're probably going to end up carrying on paying SA rates. So from their point of view, they're not too bothered. Doing it the other way around, realistically, you've got to refinance and suck up any early repayment charges, I'm afraid, Melinda. Sorry.
Yeah, that makes complete sense. Are you happy with that, Melinda? Hello, Melinda?
She gave the thumbs up. Yeah, she's on mute.
Yes, I am. Thank you.
Okay, great. That's great. Okay, thanks a lot, Sam. Appreciate that.
No problem at all, guys. See you all later.
Yeah, you're great. Always. Thank you very much. Thank you. Much appreciated.
Bye.